Hey everybody, thank you for joining. We have audio, always a good sign. And let me see. Oh, Mr. Hammer, you rock. Thank you so much. I see you out there. I see everybody out there. This one is an interesting video. And as usual, about once every week or 2 weeks or once a month, we do an I Got Challenge segment. And now that our crypto bags are full from the summer shopping spree, we can focus on equities. And I got a lot of questions recently coming up regarding equities, what to buy, what not. And this is kind of coinciding of a number of different requests in one. But Crypto Geek, who is a Patreon community member and a crypto person, is also buying equities. And they had a very interesting thesis. So let's talk about some of the equities that are really beaten down right now and what is the best going out to 2030. Hang on to the end because this is valid for everybody. We'll be talking a lot about stock valuations, Tesla, Google, impact of what's happening around the world on these different stocks. We'll talk about Nvidia, semiconductors, FSD, and a whole bunch more. We'll even touch on some things that are happening in the world that impact everybody out here too. And as usual, this is not financial advice. And if anybody wants to challenge me, jump into the Patreon community. As we mentioned, it's a casualty of the bear market. People have decided they don't want to come anymore. But anyway, let's just jump in. It always makes me very embarrassed to mention anything. But this is from Crypto Geek. And I love this one. I saw James's Tesla oversold video, and it was no doubt an amazing analysis. I agree on some, but disagree on others. And here are my rebuttal points. First one we will tackle is you say Tesla total revenue by 2026 could be 116 billion, which is massive. However, in my opinion, it's not super high. Google today makes an annual revenue of 300 billion plus, which will be more than 2x of what Tesla will make 4 years from today. How do I respond to that? Good one. And I had to go back and look at all the numbers, and I have a ton of numbers that are kind of my rebuttal to your rebuttal. But again, I can't explain how much I love these segments because it keeps me honest and it keeps me keep checking my investment theses to make sure I'm not missing anything. And there's a whole bunch of lessons here for everybody out there. So first of all, let's look at Google peer value before we start comparing it to other things. And at the bottom of this list, trading at a PE of 11 is Meta Platforms, formerly known as Facebook. And that's probably going to be a PE of 9 tomorrow because it is tanking after hours, completely missed earnings. And that's the importance of the big topic of today is earnings growth. And only Meta beats Google in terms of value. Google is a severe value stock trading at 18.9, 18.6. Price to earnings ratio, which is under 20, which is typically unheard of for a company that's growing. And Google earnings growth is about 12.8%. But remember that number. We'll come back to that in a second too. So let's look at how the future looks from this is from Wall Street. This is Google revenue and earnings numbers out to basically the beginning of 2025. And a couple of things to note here is, yes, the revenue trajectory is up, slight slowdown in growth for, year-end 2022, early 2023, because they're factoring in the recession. But the earnings growth is down from the beginning of 2022. And that is what punishes the stock. Let's look at what Tesla looks like. You can see the revenue trajectory is much more vertical. And the earnings is much straighter. That's one of the reasons I refer to this sometimes as a recession-proof stock. But the most important thing, getting back to your question regarding revenue and revenue size, is this little chart here. This is Google versus Tesla revenue out to 2024. You can see that Google is a lot more. It is north of 350 billion, whereas Tesla will be about 150 billion, 140 billion or so. But the key is not revenue, but it's earnings growth. So we'll talk more about that in a second. The second part of your question was, Tesla is not a good value by market cap. Current market cap of Tesla is 700 billion and Google is 1.2 trillion, which revenue by market cap makes Tesla not a good value. So let's dig into this a little bit and break it down like we will with all of them. Make sure I'm in the right place here. First of all, what I did, I created a weird hokey ratio for you, which I've never done before. But I call this the revenue per dollar of stock value. Really, really strange. But if you look at revenue of 360 billion versus Tesla revenue of 146 billion out to 2024, and you assume the current number of shares today, Google has 13.01 billion shares, Tesla has 3.15 billion shares, and the revenue per share today is $27.67 for Google. It's $46.23 for Tesla. But if you take the stock price today and you calculate the revenue per dollar of stock price, Google is 29 cents and Tesla's 20 cents. So they're not too different there. But remember, this is a hokey ratio and we are looking forward. But that revenue per dollar of share price of 9 cents difference is not a big deal. And remember as well, just a reminder, some of these ratios are very different to the ones I presented back in August of this year, because Tesla went through a 3-for-1 stock split and Google had a 20-for-1 stock split. So a lot of things are very different. But this next slide is critical for us all to focus on. If you look here, this is Google earnings since Q1 2021 to Q4 2022 and the projection. And you can see I drew a crude little arrow over it. Up, peaked Q1 2022, and then down, back at Q1 2021 levels. Wall Street and analysts hate this. They hate it because they like a growth story, and growth is what values the stock, the basically value of future discounted cash flows. And if that is falling, that does not bode well for valuations going out. And as I always say, this might be, if this kids in the room might be a little bit of a scary picture, but it's what they call an earnings slowdown is the kiss of DEATH, which is kind of terrifying. This is what Wall Street does not want to see. This is a beautiful statue, by the way, so I just wanted to share it. Look at it like art, not something that's scary. Let's look at Google versus Tesla earnings and see how they stack up here. This is the Google earnings per share versus Tesla earnings per share. Google's in blue, Tesla is in red. And yes, Q3 2022, Q2 2022, Google did have a slight miss, and that is why it's a little bit down, but that was due to a whole bunch of things like the C-19 policy in China, shutting factories down, which did hurt earnings. The next quarter also got hit because of logistics. And again, all of those sales that couldn't get fulfilled in Q3 will be in Q4. So there's no doubt in my mind that that new Q4 red block will be much higher than ever before. And again, this is going to be critical. So let's do a quick refresher on what we really want to focus on today, which is how we estimate future value of stocks. For me, a key ratio is the PEG ratio. This is the PEG ratio for Tesla on August 1st, 2022. I calculated at a 0.858x, and anything under 1 is excellent. But you can see here the numbers are different. The price per share was $6.50. Actually, Tesla's higher today because it went through a 3-for-1 stock split. Earnings per share was $12.42. PE ratio is 52. And then you calculate your earnings growth. But when we look at the pegs for Tesla versus Google today, you see here the price, last price. In fact, when I did this, I think Google fell down another 85 cents. So it's just under $95 now. But again, the forward PE is 16.47, and the PEG ratio for Google is 2.3. And according to these numbers as well, Tesla, last price $226, forward PE is 39.01, and the PEG is 1.13, almost parity. But again, these numbers depends on how you calculate the 5-year expected PEG ratio and the PE today. By my calculations, it's actually under 1. And it's going to get a lot stronger. And this is why there's a lot of upside room for stock. And this is a key thing for you all to focus on. So from that perspective, things like revenue don't really matter. Revenue per share is kind of close for these two assets. But let's go a little bit deeper. Let's go to your third rebuttal. Google will scale faster. Google sells pure software. It's easy to rinse and repeat, which will allow them to scale faster and have higher margins than Tesla due to selling physical products. This is so true. Absolutely true. And if I had a choice, if I was an alien in space and you asked me, would you rather Google or Tesla? Which is least headache? The answer is Google, big time. But let's break it down. Let's look at frictionless software and their margins. So the Google 2022 gross margins were 25.89% so far. Tesla gross margin is 27.2%. So despite all the hard stuff that Tesla has to do, like raw materials, build stuff, ship it, program it, do over-the-air updates, etc., it still has a higher margin than a frictionless software company. And I'll explain why that is towards the very end. But that was a bit of a stunning one, because again, if you're an alien looking down, you'd say, no way, how is that possible? But that's one of the very special things about Tesla. Tesla are competing against other car manufacturers who are bloated. We'll talk more about the bloated world as well. And they got very old technology, very old ways of manufacturing vehicles, etc. So I do agree with you on the software is frictionless and high margin, but this is the money shot here. Tesla earnings per share is ramping up. The Tesla earnings growth year over year between 2021 and 2022 so far is 213.6%. And I expect that to be a lot higher when Q4 results come in. And meanwhile, Google's earning per share growth is turning negative. And that is a startling difference. And that is what is really, really important to focus on as we go forward. Next part of your question was FSD available for all. This was super interesting. And Crypto Geek believes one day FSD will be pure software and sensors. And Google with Waymo is highly capable of this. There will come a day when you install a set of sensors in your car, maybe you stick them on, and it becomes an FSD car. Ooh, could be. Let's dig into Waymo. There's not enough time to talk about all the other stuff, but you're on the right path. But the problem with Waymo is they have what's called a LIDAR car. And I see these all the time in San Francisco running around. And there's always somebody in the driver's seat, despite the fact that it's a driverless car. And the cost in 2021 for this vehicle with all this hardware, which come down a lot in price, is $180,000. And I'm aware LiDAR is coming down and hopefully they'll be able to build it for $150,000 next year. But when you look at all the different cameras, I counted 18 different LiDAR cameras and a whole bunch more sensors. You can see it's expensive. Imagine putting $180,000 into your stereo system in your car. Anyway, we're going off on a tangent here. Let's come back. Why does Elon Musk not like LiDAR or radar? So first of all, he calls them expensive appendages. Second, it's ridiculous to fill a car with these devices. There's no room for a lot of other stuff. Third, it's extremely difficult to build a precise mapping of every location that the self-driving car will be traveling. It's very unscalable to collect, build, and maintain high-definition LiDAR maps, which is a huge problem. Also, these things only run on very well-mapped areas. And fifth point is it would be extremely difficult to keep this infrastructure up to date, all the hardware, all the integration, etc. And finally, rain, fog, leaves. It's autumn, so I thought I'd mention some autumn leaves, other debris, sand, etc., carried by the wind, distorts the 3D image rendered by LiDAR, or blocks it altogether. So you need it to be not windy and sunny to be able to take it out. And that's hoping the LiDAR doesn't get blinded by the sun, which I don't think it does. But that is the problem. It does not work. It does not scale. You cannot make a car that delivers margin that costs so much. And it's so difficult to do all the other stuff that we just mentioned. That's the problem with LiDAR. So Waymo, as Elon Musk believes, is going completely down the wrong path. But they're in too deep. They can't get out now. So that's that. But maybe it'll just be a limited self-driving taxi service in certain cities. And maybe they can recoup that $180,000 from the fees they charge the drivers and passengers of those taxis. Next, software chip companies over Tesla. If this becomes a reality, there's no need to own the end-to-end market. Rather, slow them down if they do. Software will be made by software companies. Cars will be made by car companies. Just like Android running on Samsung Pixel, OnePlus, etc. Windows on Dell, HP, etc. So my bet is on software companies and chip manufacturing companies rather than Tesla itself. So we're going to go down the chip route for a second, but I'll come back to the importance of vertical integration as well in a minute after that. First of all, chip companies. I'm glad you mentioned. I pulled in my favorite, which is Nvidia. And here I pulled in the PEG ratio because we just went through PEG for Google, which is 2.3. PEG for Tesla is 1.13, but by my calculations, based on my predictions, it's actually under 1. And Nvidia 1.69. So you can kind of see that the chip company, Nvidia, is right between Tesla and Google from a PEG ratio perspective. And you can see all the other stats in there. You can look at yourself. And yes, it is interesting. And yes, maybe chip companies are better valued than software companies. Based on this PEG, you could argue that is the case, but there are some headaches. So first of all, let's look at the chip margins. Chip margins are very high. The Nvidia 2022 gross margin is 26.1%. Tesla is 27.2%, and Google is higher than Nvidia. So that is the gross margin news. In addition, there are some challenging times for Nvidia coming forward. If you look here at the huge dip in earnings for 2023, it's going to be hard, and they are constantly being revised, but obviously they've been thrown a whole bunch of headwinds, and in particular, this one. I call it the chip warfare issue, and unfortunately, Nvidia has been caught in the downdraft of a couple of things like Ethereum moving to proof of stake, people not using graphics cards to mine Ethereum anymore, and of course, the China-US conflict and US cutting off semiconductors to China and other places as well. And this is called the chip warfare. So you can see all the different stuff that's happening around. You've got Nvidia knocking on TMC's door in Taiwan, begging for, what do they call them? Some 3mm chips or something, 3nm chips. I can't remember all the details, but there's a lot of strange stuff going on. And this is a severe headwind to Nvidia. Yes, we'll get through this, but I just don't know when. Next, let's jump into the conclusion. I'm going to come back to vertical integration as well. Hopefully I remember. But first, when it comes to investing, you have to play where the puck is going to be, as Wayne Gretzky used to always say. So big shout out to the Canadians over there. And Wayne, if you're watching. Second, low price earnings ratio does not mean high value. Growth is the key. So I put a little orange arrow there to show the importance of earnings growth. Everybody focus on earnings growth. Be absolutely militant about focusing on that. As soon as earnings growth slows, it's the kiss of, you know what, drop a comment below if you know what the last word is. I don't like saying it myself. Next, there are some things happening with bloated companies. Sundar Pichai, he's the CEO of Google. He implored his workers. He said, please be more entrepreneurial. Please work with greater urgency, sharper focus, and more hunger than we've shown on sunnier days. And Sundar hints there are startup employees who have lost their jobs over the last 6 months who are hungry for Google roles. So again, when I quote people, everybody, I'm quoting them. These are not my words, so please don't be offended. But this is interesting. And this is kind of the part of the problem we're seeing maybe within big tech and other corporations. And this is per Statista. Again, not my view of the world. But if you look here on the left, you got the different age groups. Blue is 18 to 29, orange 30 to 44, yellow 45 to 64, and teal 65 plus. Employees should always go to work, go above and beyond at work. And then if you look at the second view, obviously 82% of people who are teal, 65 plus, believe going above and beyond all the time. On the right-hand side, you've got employees should do the work they're paid for. No more, no less. Only 28% of people above 65 believe that, whereas 65% of people, 18 to 29, believe that. And believe it or not, guess what the average age of the employee at Google is? It's between 20 and 30 years. 60% of staff are under 30 at Google, which is stunning. They don't hire people like myself and Sanjay in our 50s, guys that work and ride 1,000 horses a day who don't know how to stop working. But maybe these companies should think about that as well. This is the whole quiet quitting revolution. No offense, there's tons of people in their 20s. People work with us here who work their tail off. But something is going on, and I can't quite put a finger on it. And I did mention this yesterday, and there was a huge backlash about it. Again, my problem with Twitter, I mentioned Elon's words regarding certain biases and that he would like to cut 75% of jobs. My frustration, why I was angry yesterday, to make it perfectly clear, again, so people understand, is they have 7,500 people. A ton of them are developers. Why can't they solve the bot problem? And the reason I am passionate about the bot problem is those bots aren't bots. Those bots are thieves. They are there to steal people's money. That's why I get upset. If they're just bots just hanging around and playing or pushing their social agenda, that's fine. But the fact that they are thieves bothers me. So that's the issue with that one. And also, Google dominance. They have these things called Google dominance fines, and it's no fun being number one. Another headwind for Google. Nvidia have their own headwinds as well. But here, Google's fined $113 million in its second India antitrust penalty. They've been fined billions in Europe, etc. And these things just keep stacking up. I don't know why it is so hard and why they're getting sued so much, but that is also hurting the business and the bottom line. Let's get to the key slide here. Last one. And this is Google versus Tesla out to 2030. And again, it's based on the price today and my earnings projections. And these projections change all the time. But again, these are my sandbag projections for Tesla. They don't include FSD revenue. They don't include solar revenue. They don't include energy or all the other S curves that are colliding. And you can see here, the price today is $225.50, trading at a P of approximately 55. Earnings per share is $4.10, but it's going to go a lot higher. Next year, I think they could do $7.50. The year after that, $13, etc. But based on this, and based on a reducing PE ratio, I believe Tesla could easily, sandbagged, be a $3,000 stock by the year 2030. That is a 1,229% return from where we are today. Now, if you look at Google, I have my own price projections and my own earnings per share projections, and the fact that they're trading at a PE of 17 today. I believe that PE will go back to 25, maybe 30 when the market rebounds and people go risk on again. It'll bounce right back up, no doubt in my mind. Google will be a $160 stock in no time. But if you look at where I believe it could go over time at these current trajectories, which could change, I believe Google could be a $374 stock by the year 2030. Again, also sandbagged, but that is only a 297% return on where we are today. So the question is, what's in your pocket? Why do I like Tesla? Because it'll give you 1,000% more return in the next 7 to 8 years. And that's the reason behind it. So I agree with half of what you say, but you got to look at earnings growth, and that's key. And the dominant position and fighting things like antitrust suits, etc. Who knows? Those fines may come to Tesla. The European Union may fine Tesla in 5 years saying, you're too dominant. Stop it. FSD is not allowed. You got to turn it off in Europe because it's too good and it's killing our native car companies. Who knows what they're going to say? Anything's possible. But for now, they are my price predictions. And that's why I am nearly 85% Tesla in my equity bags. I own Google and I own a little Nvidia as well. So I just want to share that in full disclosure. But great questions. I love this session. Hope you like the content. Hit the like if you do. And I'll see you all tomorrow. Bye. And a big thank you to everybody in the chat and the mods and everybody else.